On Wall Street, everyone believes the secret to getting rich is simple. Buy low, sell high. Outrun the crowd or get inside information a few seconds before everyone else. But there was one man, among all that noise, who chose a different path. He didn't care about short-term price swings. He wasn't tempted by the hot stocks on financial headlines. And he almost never rushed to hit the sell button. His name was Philip Fisher, and his investing philosophy completely changed the way Warren Buffett saw the world. Fisher didn't believe investing was a game of intelligence. He believed it was a game of understanding. He once said, "Don't buy a stock, buy a part of a business you want to own forever." And strangely enough, while everyone else was chasing prices, Fisher was chasing meaning, value, and the people behind each company. With that mindset, he turned the idea of common stocks into uncommon profits. If you've ever felt lost among thousands of ticker symbols, lost sleep over market ups and downs, or asked yourself, is there a more sustainable way to invest? Then this video is for you. Because right now, we're about to explore 6 timeless lessons from Common Stocks and Uncommon Profits, the book that helped an entire generation of American investors stop guessing the market and start understanding it. Part 1. Philip Fisher's philosophy: quality over cheapness. When Philip Fisher was young, people often asked him, "How do you find such high-return stocks?" He would simply smile and say, "Because I don't look for stocks, I look for great businesses." If you notice, most investors today are still obsessed with prices. We open our apps, watch the red and green charts, and within seconds, our mood rises and falls with those numbers. We tell ourselves, this price is so cheap, it must be a good buy. But Fisher would say, the bargain you see today might be the trap you fall into tomorrow. He was born in an era when the market believed investing was all about bargaining. Buy low, sell high. But Fisher realized something deeper. Truly great businesses aren't priced on a stock ticker. They're measured by how fast they change the world. Instead of hunting for cheap stocks, Fisher searched for companies led by people who thought beyond the next quarter. Leaders who reinvested profits, built cultures of innovation, and put customers before shareholders. He loved visiting factories, talking with engineers, and meeting frontline employees, the people who truly understood the company. To him, investing wasn't about reading financial reports. It was about reading people. One classic story: when most investors ignored Motorola because its stock looked too expensive, Fisher saw something else. He saw not just a radio manufacturer, but a gateway to the coming era of mobile communication. So he invested heavily. The result? Motorola became one of his legendary investments, multiplying in value many times over the years. Fisher believed that the stock of a great company is never truly expensive if you're patient enough. That wasn't blind optimism. It was conviction rooted in genuine growth and quality. A great company, he said, is like an oak tree. It grows slowly, but its roots run deep. A cheap company, on the other hand, is like a weed. It grows fast, but dies quickly. He once wrote, "A mediocre company, no matter how cheap you buy it, will only give you mediocre results. But an outstanding company, even at a high price, will bring you extraordinary returns over time." The market will always fluctuate. News headlines will always make you doubt your choices. But Fisher believed that real wealth comes from patience and deep understanding. He didn't invest in numbers. He invested in belief. The belief that a company will get better year after year. And that's what most of us forget. Investing isn't about racing the market. It's about choosing the right path and staying on it long enough. Today, when Warren Buffett says, "I'm 85% Graham, 15% Fisher," he's acknowledging that it was Fisher who helped him realize this truth. The real value doesn't lie in how cheaply you buy, but in finding something truly worth holding on to. Fisher's lesson is simple, yet sharp. Don't look for cheap stocks. Look for companies that are becoming greater every day. Because in the long run, quality always beats cheapness.
Part 2. The Scuttlebutt Method. Learning about a company beyond the balance sheet. Most investors believe that truth lives in the numbers: revenue, profit margins, EPS, PE ratios, free cash flow, all neatly listed in hundreds of pages of annual reports, and they think that reading them all is enough to understand a business. But Philip Fisher didn't believe that. To him, a company was a living organism, and numbers were just its vital signs, not its soul. If you want to know how healthy a company really is, you have to step outside the office, step away from your screen, and listen to what people are saying about it. That's what Fisher called the Scuttlebutt Method, one of the most original ideas he ever gave to the investing world. The word scuttlebutt originally came from the Navy. It meant the place where sailors gathered to gossip and share rumors. Fisher borrowed that term to describe a way of collecting real-world information, talking to employees, customers, suppliers, even competitors. He believed that, quote, "What people say about a company is often more truthful than anything the company says about itself," unquote. Imagine you're researching a tech company. Its financials look perfect, revenue rising, profits steady, debt low. But then you talk to a few engineers who work there, and they tell you, quote, "We're losing our best people every month." Then you talk to a customer, and they say, quote, "Their service has gotten really slow lately," unquote. Those small comments might seem trivial, but they're early warning signs of decline, the kind that numbers haven't yet revealed. Fisher would spend weeks doing this kind of investigation. He'd ask employees if they were proud to work there. He'd ask suppliers whether the company paid on time. He'd ask customers if they truly trusted the product. And most importantly, he would listen. Listen to how people spoke about the company when no one asked them to say something nice. Once, he avoided a major investment after hearing a low-level employee say that management only cared about the stock price, not the product. A few years later, that company collapsed under internal scandals. Scuttlebutt had saved him a fortune. This method might sound old-fashioned, but in today's world, where everyone invests from behind a screen, it's more valuable than ever. You can read 10 reports or 20 analyst notes, but you'll never truly understand a company until you talk to real people with real experiences. Scuttlebutt teaches us a lesson that goes far beyond investing. Don't just trust data, trust human experience, because in the end, it's people who create or destroy a company's value. Fisher once said, "Investing isn't just the art of analysis, it's the art of listening to what the market hasn't said yet," unquote. And that's what made him different. While most investors stared at their screens, Fisher listened to the real world, and that's how he saw opportunities everyone else missed. The lesson? To understand a company, don't just read its reports. Read the people behind them, because that's where truth and profit truly hide.
Part 3. The 15 points of a great company. When Philip Fisher was once asked, "How do you know if a company is worth investing in for the long run?" he simply smiled and said, "I don't have a crystal ball, but I do have 15 questions." Not a magic formula, but a mental map to help investors find extraordinary companies amid the noise and chaos of the market. 1. Does the product or service have long-term growth potential? Fisher always started with vision, not revenue. He believed great companies don't just sell what's hot, they create what's next. Think about it. Apple didn't just make phones, it redefined how people communicate. Amazon didn't just sell goods, It reinvented how the world shops. If a company only sells what works today, it disappears when the trend fades. But if it builds what the world needs tomorrow, it endures. 2. Is management capable and visionary? A company can never grow beyond the limits of its leaders. Fisher spent time observing how CEOs made decisions. Were they willing to sacrifice short-term profits for long-term strength? Did they keep their promises to employees and investors? He once said, "A good management makes me want to invest. A bad one makes me want to run." 3. Innovation and R&D. Fisher saw innovation as the backbone of growth. He distrusted companies that live off their legacy, relying on old products while creating nothing new. If a company doesn't invest in its future, no matter how profitable it looks today, it's just a dying past in disguise. 4. Are the profit margins stable and expanding over time? Fisher called this the sign of an invisible moat, the true ability to defend value. Short-term fluctuations happen, but if margins remain strong year after year, it's proof of real strength, brand, systems, or culture. 5. Does the company control its costs well? A great company spends wisely. As Warren Buffett said, "You don't have to be smarter than others to get rich. You just have to be more disciplined." Fisher looked for companies that practiced rational spending, investing where it mattered, cutting where it didn't, and never let greed cloud judgment. 6. Does it have a durable competitive advantage, a moat? Not every company needs a monopoly, but it must have something others can't easily copy. It could be brand, technology, data, or a loyal community. Fisher said, "If you can replace a company with its competitor in one day, it's not worth investing in." 7. How does it treat its employees? Fisher believed, how a company treats its employees will reflect how it will treat its shareholders. A company that encourages creativity and respects its people builds the inner drive to go farther. He often asked employees, "Are you proud to work here?" If the answer was no, he moved on. 8. How does it treat its customers and suppliers? A company might be great at selling, but if it's hated by customers or bullies its suppliers, it won't last. Fisher looked for mutual respect because that's the foundation of lasting growth. 9. Debt management. He warned that debt isn't evil. Debt is only good if you can sleep well with it. Companies that borrow for short-term gain will always live in anxiety. 10. Does the company think long-term? Fisher admired businesses that weren't afraid to plan for the next 10 to 20 years. He once invested in a company after hearing its CEO say, "We're not trying to make the most money this year. We're trying to make money forever." 11. Is the company culture honest and transparent? No number is beautiful enough to hide dishonesty. For Fisher, integrity was non-negotiable. If management hid small things, they'd hid bigger ones when the stakes rose. 12. Can the company adapt to change? The world changes fast. Fisher believed good companies defend, great companies adapt. He looked for businesses willing to evolve their models, products, or strategy without losing their soul. 13. Dividend policy and reinvestment. A smart company doesn't just know how to distribute cash, it knows when to keep it. Fisher disliked large dividends if the company still had strong growth opportunities. He knew that $1 reinvested wisely could become 10 in the future. 14. The relationship between growth and profitability. Growth is good, but only if it's quality growth. If revenue rises through discounts, debt, or massive marketing spend, Fisher saw that as a red flag. He looked for growth born from great products and loyal customers. 15. Can the business scale? Fisher always asked, If revenue doubles, will costs double too? A great company grows efficiently. Its profits expand faster than its expenses. That's the mark of a powerful business model and the dream of every long-term investor. When Fisher finished his 15 questions, he wasn't just choosing a stock. He was choosing a partner, a business he could live with for decades. He once said, "A good stock isn't for trading, it's for marrying." Those 15 points were his pre-marriage checklist for every investment. If a company couldn't pass, he'd simply smile, walk away, and wait for the right one. The lesson? Investing isn't about guessing prices. It's about finding companies you can trust and growing together over time. Fisher's 15 points are the compass that guides you on that journey. Part 4. The art of holding, when patience becomes a competitive advantage. There's a strange paradox in investing. Everyone talks about long-term investing, but very few people actually stay long enough with their own investments. Because the market doesn't just test your wallet, it tests your heart, nerves, and faith every single day. Philip Fisher once told a story about a friend who invested during his time. That friend bought shares of Texas Instruments very early on, just a few years after the company began commercializing the world's first silicon transistor. At first, the stock doubled, then tripled. The investor sold everything and celebrated his big win. But a few years later, Texas Instruments became one of the great technology icons of the 20th century. Its stock had risen more than 40-fold. Fisher quietly said, "He won, but he lost to time." To Fisher, time was the greatest competitive edge most investors never developed. He believed a great stock doesn't need to be bought many times. It only needs to be held long enough. Holding, not out of stubbornness, but out of understanding. Fisher was not blindly devoted to the buy and hold mantra. He didn't hold stocks because he was lazy to sell. He held them because he deeply understood the businesses behind them. He said, "If you don't know why you own a stock, you'll panic the first day it goes down." Owning shares of a great company, Fisher said, is like owning a fertile piece of land. You don't need to plow it every week. You just need to give it time to work. But that kind of patience must be built on understanding, not blind faith. The market feeds on news. Real investors feed on patience. Fisher often smiled watching Wall Street panic over daily headlines. He said, "News is the food of speculation, but value is the food of investment." When markets turned red, he didn't look at charts. He looked at companies. Are they still innovating? Do customers still love their products? Does management still think long-term? If the answers were yes, then falling prices were opportunities, not threats. Patience, the most underrated financial skill. Fisher believed investors didn't need to be smarter than the crowd, just more patient. He often said, "The market is a device for transferring money from the impatient to the patient." Patience, however, is not mere waiting. It's waiting the right way, waiting with confidence, not anxiety. Warren Buffett later echoed this idea in his own words. "If you're not willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Time, the true ally of great businesses. The companies Fisher admired most, like Motorola, Texas Instruments, or Dow Chemical, all shared one thing in common. They needed time to become great. No company can prove its worth in a single quarter, just like no oak tree grows tall in a single spring. Fisher said, "When you own shares of a truly outstanding business, time works for you, not the market." Fisher's lesson, know when to do nothing. In a world obsessed with new strategies, Fisher chose the simplest one of all, patience. He understood that constant action doesn't equal progress. The market rewards those who wait, not those who predict. When asked, what's the secret to successful investing, he simply said, let time do the hardest work. In the end, Fisher taught that real wealth doesn't come from buying at the right time, but from holding in the right place. Not from seeing farther than others, but from waiting long enough for that vision to come true. Final lesson. In investing, patience is not passivity. It's the highest form of action, where time, value, and conviction quietly work in your favor.
Part 5. When to sell a stock. Knowing when moving on is actually moving forward. There's an old saying on Wall Street. No one ever went broke taking a profit. But Philip Fisher didn't quite agree. He once smiled and replied, "True, but plenty of people got poorer by selling too soon." The biggest mistake isn't buying wrong, it's selling wrong. Fisher often said that most of the greatest fortunes he'd ever witnessed didn't come from picking the right stock, but from holding the right company and refusing to sell when everyone else did. He told the story of his investment in Motorola, back when it was just a small radio manufacturer experimenting with transistors. Many investors rushed to sell after the stock rose 50%, saying, "That's enough profit for me." But Fisher didn't sell. He said, "I sell only when the reason I bought no longer exists." Motorola went on to become a global technology powerhouse, returning many times his original investment. The only 3 real reasons to sell, and nothing else. Fisher was extremely disciplined when it came to selling. He believed investors should sell a stock for only 3 legitimate reasons. 1. When you were wrong from the start. If the assumptions that led you to buy turn out to be false, say management proves incompetent, or the company's competitive edge turns out to be temporary, then sell immediately, even at a loss. Fisher called this the market's tuition fee. 2. When the business stops being itself. If the company starts losing its core DNA, stops innovating, expands recklessly, or leadership becomes obsessed with short-term profits, it's time to step aside. Fisher once sold a leading chemical stock simply because the new CEO had started chasing prestige instead of technical progress. He said, "A company can't stay great if it's no longer humble enough to keep learning." 3. When a clearly superior opportunity appears. Not another opportunity, a better one. That means finding a company with stronger leadership, a longer-term vision, and growth prospects far exceeding what you currently hold. In that case, selling isn't giving up, it's reallocating your capital to a brighter future. Don't sell out of fear. The market will always test your nerves. Fisher understood that the market is a master manipulator of emotions. Prices will fall, headlines will scream, and people will shout, "Sell before it's too late." But he believed it's not the market that makes us poor. It's fear that makes us act foolishly. Selling just because the price drops is an instinct, but usually the wrong one. If your reasons for buying are still valid, the company is still growing, its product still strong, its leadership still steady, then don't let the daily ticker shake your conviction. Because Fisher knew that a company's growth curve is never a straight line. It dips, twists, and turns. And in those dips, the patient investors are the ones most richly rewarded. When not to sell? When reason wins over emotion. Fisher warned that investors often sabotage themselves by being too clever. They sell to lock in profits and buy back cheaper. But the truth is, no one consistently predicts bottoms. He once said, if you sell only because you think you can buy it back cheaper, you're no longer investing, you're gambling. Many people try to sell at the peak and end up missing entire decades of growth. Fisher chose the simpler path, to trust in great companies and let time do the hardest work. Selling isn't just an action, It's a test of character. Fisher viewed selling as a moment of honesty. Are you acting out of logic or emotion? He said, if you sell out of fear, you're running away. But if you sell because your vision is changed, you're moving forward. That distinction separates a mature investor from someone merely chasing the thrill of winning and losing. In the end, knowing when to walk away is also wisdom. Fisher believed that the art of investing lies not only in choosing well, but also in knowing when to let go. Not because you're tired, but because you're clear-eyed enough to see that value has moved elsewhere. Sell when the reasons you once believed in no longer hold true. Don't sell just because the world around you has lost its calm. Final lesson. Selling isn't the end of an investment journey. It's the beginning of awareness, where you learn that maturity sometimes means having the strength to stand up and walk away at the right moment.
Part 6. Focused Investing. Know fewer companies, but know them deeply. Warren Buffett once said, "I'm a disciple of Benjamin Graham, but I follow the path of Philip Fisher." And that's where the real difference lies. If Benjamin Graham taught investors how to buy cheap, Philip Fisher taught them how to understand deeply. So deeply that you could talk about a company the same way you talk about your best friend. Fisher didn't believe in diversifying for safety. In a world where every finance book says don't put all your eggs in one basket, Fisher went the other way. Over-diversification is a sign of ignorance. He wasn't against spreading risk, but he believed diversification should come from understanding, not fear. According to Fisher, you don't need 50 or 100 stocks to sleep well at night. You only need 5 to 10 truly exceptional companies, and to know them deeply enough to understand what creates their value and what could destroy it. The story: one basket and the right hands. Fisher once told the story about a young investor who asked them, "If I only invest in a few companies, isn't that too risky?" He smiled and said, "No. Risk doesn't come from having your eggs in one basket. It comes from not knowing who's holding the basket." That was his philosophy. When you understand deeply, you stop fearing volatility. When you understand the essence, daily price swings can't shake your conviction. Focused investing demands commitment of mind, not just money. Fisher would spend months studying a single company. He'd visit factories, talk to engineers, employees, customers, and even competitors. He wanted to know, does the management truly love what they do, or just the profits? Is the company still innovating, or just living off past success? Do employees feel proud to say they work there? For Fisher, investing wasn't about reading financial reports. It was about understanding the soul of a business, the difference between knowing the price and knowing the value. Fisher once said, "Most investors know the price of the stocks they buy. Very few understand the real value of the businesses behind them. Those who only know the price sell when the market panics. Those who understand the value buy more." And it's this depth of understanding that allows focused investors to stay calm amid market noise, because they know they own a piece of a genuine value-creating machine. Focused investing isn't for the impatient. Fisher warned, if you can't stand seeing your stock drop 30% while still believing in the company, you shouldn't call yourself an investor. To focus is to endure loneliness, to trust your own analysis when the crowd is panicking, to hold on when everyone else is selling because you understand something they don't. He believed the market rewards depth, not breadth. A lesson from modern investors. In today's world where people chase diversification, ETFs, and portfolios with hundreds of stocks, Fisher's philosophy may sound old-fashioned, but in truth, it's more relevant than ever. Because now investors can buy thousands of stocks with just a few clicks, and yet the more they diversify, the less they truly understand what they own. Focused investing reminds us, you don't need to know everything to build wealth. You just need to understand a few things deeply. You don't have to run faster than everyone else, you just have to stand firmer when everyone else is afraid. Conclusion.
Focus is a virtue, not just a strategy. Fisher taught that investing isn't a game of probabilities, it's a test of patience, depth, and conviction. Know a lot about a few companies rather than a little about them all. Because in that depth, you don't just find profits, you find peace, even in a market that's always in chaos. In the end, Philip Fisher didn't just teach us how to pick stocks. He taught us how to think like true investors, to be patient, to understand deeply, and to believe in long-term value over short-term noise. In a world obsessed with quick profits, he reminded us that lasting wealth only comes to those who have the courage to move slowly but steadily. If you want to dive deeper into how Fisher chose his companies and why Warren Buffett called him his true teacher, I'll leave a link to the book in the description below. Read it, and maybe you won't just become a smarter investor, you'll start to see the market with an entirely new perspective.